Hello. The purpose of this video is to introduce you to stocks that pay dividends for companies that have a constant dividend growth policy, and to show you how the stream of dividends can be used to calculate the intrinsic value of each share of stock, or the price, estimate the price of each share of common stock. So in Seminar 4 Lecturette of 640, the first principle is, that's highlighted in capital letters, constant dividend growth model of the intrinsic value of a share of common stock. Now this presents the principle and then gives us an example of using the principle. So let's read this. The intrinsic value, which is to say the fundamental economic value and its equilibrium market price of a share of common stock that's expected to pay annual dividends that grow at a constant rate each year, is equal to, now this is the equation, dividend times the factor 1 plus g divided by the factor k minus g, where D is the current annual dividend, G is the constant dividend growth rate, K is the required rate of return. The required rate of return can be calculated using the capital asset pricing model. That's a risk-adjusted rate of return. It's the opportunity cost or time value of money for the investor for making this investment. So if you're the investor, it's whatever you would require as a rate of return in order to be happy with the investment. So here's an example of using the equation to solve the problem. A common stock that paid a current annual dividend per share of $2.50 and had an expected constant dividend growth rate of 5% per year with a required rate of return of 18%, would have an intrinsic value of 2.50, that's D, plus 1 plus 0.05. 0.05 is the growth rate, G. 18% is K, divided by 18K minus G. So you make that calculation, it gives you $2.62 divided by 0.13, and it estimates the intrinsic value or equilibrium market value of the stock per share at $20. Now if we go to the end of the lecturette, we have the class discussion questions. And number 5, problem solving for stocks, uses this model. So we have A, B, and C, 3 questions using this model to estimate the intrinsic value for each share of the stocks. So let's look at A. Stock B pays a current dividend of 4%. That's D. It pays a dividend of $4. That's D per share per year, with a constant dividend growth rate, that's G, of 3%, and has a required return of 12%. 12% is K in the model. Okay, so those are the variables. We need to know the dividend. We need to know the growth rate, the annual rate at which dividends are growing per year. And we need to know the investor's required return, 12%. So to solve the different parts of this problem, you need to go back and use the principle that we just presented. This constant dividend growth rate model of the intrinsic value of a share of common stock. Okay. Hope that's helpful. Have a nice day. Bye.